All right. We're going to get started in just a few minutes. Ladies and gentlemen, thank you so much for joining us today. All right. We're about ready to get started. Can you guys hear me? I see my little microphone moving. Can you guys hear me? And can you see my screen? If somebody can send me a real quick chat message, just letting me know that we're good to go. Thank you, Miss Jessica. Okay. So we are going to talk about the events that happened this week. Thank you, Miss Mickey. Appreciate you being on. Miss Yolanda, thank you, ma'am. Okay, so you guys can hear me. Wonderful. This has been one scary, scary week. Why? Because starting at the beginning of the week, the stock market completely collapsed. It had been doing so well. And then this whole coronavirus, which I think is completely overrated, and I think people are just making a real big deal out of something very minute. But that's a topic of conversation for a different day. Um, but what did happen is that people lost a hell of a lot of money this week. So, for example, I have one client who had $130,000 that we were getting ready to move, and we checked on it 2 weeks ago, and it was 130,000. We checked on it last week, and it was at 115,000. By the time we actually move the money next week, which we're meeting on Monday, he may very well be at 100,000. Which means that he would have lost 30,000 throughout the course of 2 weeks, and that's a very, very common story. So, why do I share this with you? The reason why I share this with you, ladies and gentlemen, is because you don't understand the amount of value that we can bring to individuals that are looking for an upside without any downside. Okay, that are looking to be able to participate in the growth of the stock market without being able to feel any of the negative effects of situations like this week. And there is really only one product, and I'm being 100% honest with you. There's only one product that can do that, and that's an indexed product. An indexed product within a life insurance company is the only product that can offer those guarantees to clients. And guess what? The only people that can sell that product are us, life insurance agents, because people that sell products that are in the market, like people that are broker dealers or true financial advisors that have what's called a securities license, most of them are very, very limited on the products that they can offer clients, which means that unless their broker dealer, I mean the people that are above them, unless they allow for them to sell an indexed annuity or an indexed product within a life insurance policy, um, they can't sell it, which means that they can't offer those guarantees. And I'm going to be real honest with you. I'd say maybe 97, 98% of them are not going to be able to sell those products. And then there's a small 3% that can, right? So what that leaves us is this huge market to be able to help a lot of people. So what I wanted to do today is I actually wanted to share a couple of things with you. Okay. Well, actually, first things first. Let me let me put up an image here on my screen for you guys to see. Bear with me. Okay. So let's take a look at this. It's actually all red now, but this was earlier this week because I always check my phone. I always check stocks, and this is what happened this week. And this I checked this one last night. This one was red too, which is the BMP. Okay, so this is the current situation for people's finances and people's retirement, which is a very, very scary situation. Now, if you are young, if you are 25, if you're 30, if you're 35, you need to understand that having your money in the stock market is getting accustomed to the idea that there will always be fluctuations up, fluctuations down. The advantage that you have if you are 25 or 35 or even 45 is that you still have a good 20 to 30 to 40 years before you retire. So a risky scenario like this week, even though it is impactful to you, it's not as impactful as if you're already 65. If you're already 65 and these situations happen and you're already actively taking money out of your retirement portfolio, unfortunately, your money will run out very, very, very quickly. And so these are things that clients need to be aware of. Now, are we going to be able to solve everybody's problem? No. I have a question real quick. Okay. Ms. B, can you make sure that, thank you for that. They're saying that there's an overlap if there's something else playing. Can we make sure that everyone's on mute? Ms. B, can you make sure that you're on mute as well, please, ma'am? I don't have anything playing in the background. Can you guys let me know if there's still an overlap? We're just checking audio here. Okay, you guys still hear that overlap, or can you hear me clearly? Because I don't want to talk if you guys can't hear me well. Are we good? Are we good, Ms. B? Can you hear me well? Okay, perfect. I think we're good. Wonderful. So let me continue. I want to share with you guys. Well, let's start with this. So what this is the last 20 years of the S&P 500. So the S&P 500 is an index that you can invest in directly in the stock market. You don't have to go through an insurance company. You don't have to go through us. So the S&P 500 is a direct reflection of the economy in the United States because it's the 500 biggest companies in the United States. And for that, it's also pretty much a direct reflection of how the world economy is doing because the companies in the United States are massive, huge companies. I mean, they're the biggest in the world. So this means that if they're doing poorly, there's probably a good chance that either the economy is down or, I mean, everyone else is doing bad, correct? So the reason I share this with you is because I want to take a look at the recent 20 years, and I want to take a look at these negatives. Like 2000 was negative 10.14, 2001 was negative 13, 2002 was negative 23, okay? 2008, terrible year, negative 38. We're in 2020, so 2020 is not showing up here. We'll see how 2020 averages out because it started off really good and now it's just really bad. But this is the important part, the 20-year average. The 20-year average of the stock market of the S&P 500 is at 4%. The 20-year average is at 4%. Okay, so I want you to take a look at one of our 10-year index products. Okay, with zero risks and zero fees, and we have a 10-year average of 10.34%. Okay, so what I want you to understand here is that clients need to understand their options, and clients need to understand that they can leverage our financial products to be able to participate in those gains without losing any money. There's still some clients that are going to want to keep their money in variable accounts and mutual funds, and that's perfectly fine because at the end of the day, we're just trying to balance out their portfolio. We're just trying to figure out a way to secure a good chunk of their assets. The older they get, the more secure they need to be. The younger they are, the more leeway they have to be able to be a little bit riskier, right? And invest more money, and they can afford to lose money because they have more than enough time to make it up. But still, throughout the course of time, what we need to understand is that when you have a zero floor, when zero is a worst case scenario, zero is about as bad as going to get, then it really gives you the potential to average out at a much, much higher rate. So the most recent 10 years, 10.34% on this particular product. If we go back over here to the most recent 10 years, most recent 10 years is at 11.2. So it's a little bit higher than our index product, right? However, whenever you do these products right here, there are always fees attached to it. So there are fees attached to this 11.2. As a general rule of thumb, let's just say 2%. So 2% off the top on the 11.2. That puts us at 9.2. 9.2 here versus 10.34 here because this product has no fees. So this product has no fees and this product has no risk. This product has all the risk and it has all the fees. Which one do you think would be a better fit to middle America? The one where they could lose money or the one where they won't lose any money and they don't have any fees? It's all a matter of how you present things, but it's also on how knowledgeable and how well you can argue your case. And sometimes you'll run into some individuals that'll say, you know what, I have $500,000 in mutual funds, or I have $500,000 with Edward Jones, and I have $500,000 with Merrill Lynch, or whatever entity they have their money with, you know. And this is not an all or nothing game, guys. I mean, if they don't move their 500,000, that doesn't mean that it's over. You say, you know what, that's fine. How about we start with $100,000? By the way, if you move $100,000, you're gonna make several $1,000s in commissions. I mean, right off the bat, just with a $100,000 rollover, that's a good day at the office. But you move over the $100,000 and we just kind of let it sit there, right? And we check on it every year, and we check on it at the 5-year mark, at the 10-year mark, and then we can see just how consistent that account has been. And I'll let you know something, that at the end of that 10-year mark, when you have averaged 6 or 7% on that account, or 8%, or whatever the account did, and the other one, we actually sit down and calculate how much money they actually made after fees, and it turns out it's significantly less than what they made with you. Eventually, the rest of the money is going to come over. Okay. You have to find a balance. You have to find a balance, and you have to make sure that you have the resources and the tools and the knowledge to be able to present a strong case. So initially, for a lot of you guys that are not too familiar, not too comfortable with selling annuities, that's what I'm here for. I mean, I'm here to argue the case on your behalf, but I also would like for you to learn, right? For those of you that really want to dive into this financial product, and one person that I've been talking to about this recently, because he really wants to take his annuity game to another level, is Hector Science. So he's from San Antonio. He's one of our franchisees, and he's a phenomenal franchisee, very, very hardworking person. And so I've had a couple of conversations with him, And the only way that he's really going to be able to take his annuity game to another level is by learning all of the additional information that you need to know to be able to say, hey, look, here's why I think this would be the best fit for you right now. And you kind of start breaking things down, you know. Interest rates and how much money they're going to make is one thing, but guarantees is where the sell happens. When you tell the client, I guarantee you that you will never lose any money. I guarantee you that there are no fees associated with this account. We're just going to put the money in there. We're going to let it sit there for 7 years, for 10 years, or however. Then we're going to reevaluate, see if we can move it somewhere else to make you more money or to maximize on the situation. And then we're going to do this until we hit retirement. And when we hit retirement, we're going to start using your money. Okay, so then the question that we ask is, well, what's the catch, right? When we move clients into these products, what's the catch? If there's no fees and there's no risk, then how is it that we make money as agents, and how is it that the company makes money? Well, it's very simple. The company is going to work off of what's called a participation rate. What is a participation rate? Let me pull that up and show you. I want to go to one of our more popular annuities that we're currently pushing quite a bit. With that one. Here we go. The Power Accumulator 7. So I want to go over this particular index. So this particular index has a 10-year look back of 6.6%. This particular index has a 10-year look back of 10.34%. I'm going to show you the advantages and disadvantages of one versus the other. This one right here, this index credits at the end of every year. This index credits at the end of every 2 years. Okay. So I'll get more into details as far as why we choose one over the other in the future. But for the purpose of explaining to you how it is that the company makes money and how we're able to do this, that this works off of what's called a participation rate. Okay. For this particular index, the participation rate is 45%. What does that mean? Well, that means that if the market does 10%, you make 4.5%. You make 45% of the 10%. If the market does 20%, you make 45% of the 20%. If the market does 25%, you make 4.5%. 45% of the 25%, right? Whatever that equates to. And so the 10-year average for this one is 6.6% for a product that has no fees and no risk. Guys, that's not bad at all. So let me show you what that actually looks like. In terms of accumulation. So this is one of the little tools that I use. So let's say we move $100,000, right? And we're not doing any monthly contributions, and we're going to leave the money in there for 25 years. And we're going to go with this one because this one credits annually, 6.6% annually. At the end of the 25 years, without any additional contributions, at 6.6% average, you are looking at about $500,000. So you have increased your savings 5 times over. That's pretty freaking crazy. Why? We go back to, I want to break down this index because it's the easiest one to explain right now. This one right here. It all goes back to this, guys. Okay, so remember it's a 45% participation rate. So here's what the index did. Here's what you got credited. So year one, you made 7.59%. So this is looking at the last 10 years from 2010 to 2011, 11 to 12, 2012, 2013, all the way to 19 to 20. Okay. The index did 14%, you got 6.34. So now our average is 6.96. The index did 13.78, you made 6.2. 10.66, you made 4.8. 32.51, you made 14%. -8, you were at 0. 10%, you made 4.87. 22%, you made 10.31. -7, you were 0. 27%, you made 12.21. So your average is 6.6. Now, this other one, this one credits at the end of every second year, but this one is averaging out a lot higher. So this one, at the end of every second year, it credits the interest. So at the end of year 2, you made 28%, 0, 20%, 0, 16%, 0, 31%, 0, 12%. So our average is 10.34%. Pretty straightforward. So what if we did that one here, 10.34? Then that's what this turns into over the course of 25 years. So ideally, we would love to say, hey, this is exactly how much interest you're going to make for the next 10 years. We can't say that. We can never say that because we don't know exactly what the economy is going to do. We can just show them projections. That's all we're doing. This is just a projection. But here's the way it did the last 10 years. And these are the guarantees that I can offer you as a client. Guarantee number 1, I guarantee you that you will never lose any money. Guarantee number 2, there are no fees associated with this product. Any interest that you make, so once your account goes from 100,000 to 110,000, your new balance is 110,000. Now you are guaranteed to never have less than 110,000. And we're just going to continue to escalate this through the years until you're ready to retire. When you're ready to retire, then we're going to figure out how we're going to start taking distributions on this money. It really fits in well if they have other investments that are very, very risky. The older they get, the more they need to shift away from the risky investments and go more towards the conservative investments that can still make them a lot of money. For example, index annuities. Index annuities are a phenomenal way for clients to still have that upside, still have the downside guarantee that they're not going to lose any money, and have their product in a fee-less environment. Okay. And taking into account what a terrible week this week has been for not only the economy, but for the stock market, then it really gives you the leverage to say, hey, I really think you should look at this product. And maybe we're not going to put all your money in here, but I would highly consider to put, at least 50% of it or 40% of it, so that you know that regardless of how bad things get, that money is always going to be secure. Okay. With the annuities that we work with, we have different lengths of time that the money needs to remain there. So we have 5-year annuities, we have 7-year annuities, we have 10-year annuities. So what that means is once we move the money over, then they have to leave the money in there for that period of time, right? The better performing annuities are the 7 and 10-year annuities. So those are the annuities that are performing at a higher level. Those are the ones that are shooting out some really, really good projections. So things to keep in mind is when we're sitting down and doing a financial evaluation or financial needs analysis, we really have to see the client's current financial situation. Like what do their finances look like right now? If the only thing they have to their name is $20,000, like that's it, that's all they have, and they're going to put that into an account where it's going to be in there for 5 years or 7 years, we're really going to have to reconsider some of those options, right? However, if their money's in a 401k and they have like $35,000, $40,000 in a 401k, and let's say the client is 42, they can't touch that 401k money for another, 20 years? Because otherwise they're going to get taxed and they're going to get penalized. So at that point, a 7-year product or a 10-year product is an afterthought. Why? Because they don't need to touch that money. They don't need to touch that money because they would get heavily penalized regardless. So let's just put it somewhere really safe where you can still make some good interest rate accumulation. Now let's just monitor it on an annual basis, and let's just work on ways to really maximize that. Okay. The reason why I felt this was relevant for this week, ladies and gentlemen, is because I want you to have the confidence to reach out to people. And even though you don't have all of these tools, because this is a process, and if you really want to get into the annuity business, I'm going to teach you how to do all this stuff. This is a process. You have to take it on a step by step. step number one is we got to find some clients, right? So if you have some clients that play the stock market, you owe them at the bare minimum the opportunity to see what they could do with an indexed annuity. And like I said, it's not an all or nothing game. It's a balance game. We have to find the right balance, right? If the client is young and they just lost $50,000, the only way they're going to be able to recoup that is if they leave the money where it's at and wait for the market to go back up. And then when the market goes back up, and once they're back to the balance that they were at originally, then at that point you would say, hey, well, lesson learned. It would probably be wise to move a chunk of that or move it all over. And if you want to continue investing into variable products, but at least let's secure this chunk to make sure that if there's another market crash or another recession, that you don't lose 30 or 40 or 50% of your money. Okay. So in a nutshell, ladies and gentlemen, I want you to understand the power behind these products. And I want you to understand that these are instruments that you can offer your clients. And this is my specialty, and this is what I love to do. This and index universal life insurance is the realm where I live in. I mean, I still do final expense and I still do Medicare for some of my clients because they ask me and there's a need for it. But as far as my specialty, this is where I live. And so I want to make sure that we can help your clients for two reasons. Number one, because I firmly believe that these are good, rock solid products. But number two, because I want you to make more money. I want you to help your clients. And in the process of helping your clients, I want you to make more money. The only way that we can help your clients is if you as an individual, because I don't know your clients, I don't have any relationship with them. If you as an individual are willing to put yourself out there and say, hey, Mr. Gonzalez, I know that you had some mutual funds, or I know that you had a 401k. Was this a bad week for you? Did you lose some money? And he's going to say, yes, I did. Okay. I'd like for you to come in. I want to share with you some of the financial products that we have where we didn't have clients lose any money. And even if Mr. Gonzalez doesn't make a decision right then and there, at least you have planted the seed. Because when that account goes back up to where it was at originally, then at that point, he's going to say, okay, I don't want to deal with this anymore. I've recouped my money. Let's move it now, right? There's just a lot of different ways to go about it. So I want to give you guys an opportunity, because I don't want to keep you too long. I want to give you an opportunity to ask me some questions, because I know we have a couple of people on here, and we're also going to roll this out for people that weren't able to join us today. But what are some of the questions that you have? What are some of the things that come up immediately, or anything that you have questions about in regards to these products and how they work? Questions going once? Questions going twice? Sold. Okay, wonderful, guys. Well, you guys have a phenomenal Friday. I will see you guys again here next week. And please reach out to me via email or via message if you have any additional questions. Let's actively look out for clients that we can help, because this has been one hell of an ugly week when it comes to investing in stock market. And we definitely want to service some people. So please be on the lookout. Oh, wait, I do have a question. Hold on before I let you guys go. Do I have? Oh, Mickey, yes. I've stocked up with toilet paper in my office. So I got about 257 rolls. So if a client purchases a life insurance policy, they get a roll of toilet paper. If they purchase an annuity, they get 2 rolls of toilet paper and a squirt of hand sanitizer. So, hey man, tough times. You got to do what you got to do. All right, guys, you guys have an amazing Friday, and I'll see you guys again next week. Thank you. Bye-bye.